to Friday morning's market wrap. Short and sweet today because I'm about to jump in the car to drive down to the world's best small city, Newcastle. If you don't know much about Newcastle, have a look on the web. It is glorious. About 600,000 people live within 50 Ks. It's got a nice little CBD. It's got a nice culture. It's got some of the best beaches and surf you'll ever find. Anyway, quickly overnight, what we saw was the markets reappraising really what they're trying to think about the Fed. US GDP last night printed 1.5%, but if you rip it apart and look at the structure of it, and you look at consumption, you look at the impact of the US dollar, which wasn't a lot. It's a picture of a strong economy. Inventories were a big drag, but overall, even though it printed 1.5%, it wasn't a terrible number by any stretch of the imagination. And in some ways, it reinforces what the Fed said the night before. Now, of course, what that also does is reinforce that rates are going to rise in December, most likely. It depends on non-farm payrolls in a week's time, but that's the way people are thinking. So the big news in the sort of the last 24 hours has been the continued selling of the Aussie dollar, which is now down at 77, 78, something like that, and US interest rates, which have risen substantially. Not in points terms, perhaps, but in percentage terms, it's massive. The two-year note is up something like 16, or the basis points that the two-year note is up represents something like a 16% fall in the capital value to people who are holding them. Because obviously as rates rise, it costs less to buy. So if you bought something at 100 and the rates rise, then it's worth less than 100. It's just the way. There's an inverse relationship between interest rates and the dollar price that you pay. What we also saw was the 10 years are up, and they're back up at 217 or something like that. And so what we've got there is about a 7.5% sell-off in 10-year bond prices. So some really big moves in bond markets. Now, they're only tiny little basis points, 12 or 15 points here and 10 points there, that kind of thing. But percentage-wise, they're pretty big. And if we continue to see that 10-year push higher, then it really does question some of the valuation metrics we get with an S&P up here at 2089. Now, of course, it could go to 2135. 2100 was kind of where we talked about earlier this week, and I do apologise for no show yesterday, but I couldn't get enough reception where I was staying yesterday to run it efficiently without all the gaps and blops and all that kind of stuff. So yeah, it could rally another 10 points, could rally another 45 points in S&P terms, but the valuations are starting to get back to that stretched level. So I'll keep an eye on that. What we saw, obviously, the Aussie's lower. I've got a support zone about 30 or 40 points lower. Let me just share that chart with you. I'll share a few charts with you now. If we have a quick look at the Aussie, where is the Aussie? And I'm not going to say oi, oi, oi. Right. Okay, so we've had the rally, we've had the sell-off, we've had this trend line constraining that sell-off, downtrend line as it moved. It's broken down through the old average, and it's come down. And where I've got support is about the Fibbo terms, which is the last line of defense, is about 70-30, 70-40. So that would be where you might see a little bit of support come in. What markets seem to be doing at the moment with the Aussie dollar is that they are pricing for an RBA rate cut next week. I don't necessarily think you'll get one. I think the RBA is in play. Sorry, trying to click this so I can get rid of it. Oh, this is as suboptimal as things get. Yes, I don't think the RBA is necessarily in play next week, but the chances of them cutting after the CPI data have obviously increased. And what we've got here is this: we've just got an Aussie in a great big downtrend, and so there's a big risk around next Tuesday. If they do, the Aussie's going to get flogged, and I'd expect it to see it down at 69, 30, 40, 50. If they don't, you might see a bit of a rally. In terms of the other markets I'm looking at the moment, the ASX 200, it's broken back inside the box. So if you assume the box is this kind of thing here, top, rejection from top, break, slide down, rest, crash. right? So now we've got this this trend line here and my slow moving average. So in that 52.38, 52.25 kind of region, hopefully you can see that. In this 52.38, 52.25 region is where I'm seeing support on the day today. If that was to give way, you would see a substantial cascade lower. So you know, they're the two things to watch in the Aussie market at the moment. Euro is bouncing off, basically having a recovery from an oversold basis, and similar with sterling, and that's one of the reasons why dollar yen's be calmed. Obviously, today we've got a raft of data out in Japan, and we've got the monetary policy decision from the Bank of Japan. Is it too early for Japan to move again to QE? It probably is, but equally it's probably not. The problem that Japan's got, of course, is nothing's going to work. You know, China's just gone from 1 child to 2 child yesterday in order to, you know, stop that teetering demographic they've got, and to maybe fix the imbalance between all blokes and no girls being born, which is ridiculous. But anyway, that's another story. But Japan's really got that teetering demographic time bomb happening. So what can they do? You know, they can do more QE. They can debase the yen, which would suit me because I'm in the market for another or a new Toyota, I think, probably a Land Cruiser or something like that. But it's not going to work longer term. You know, Japan is stuck in a spiral that is weak growth, which is most unfortunate for one of the world's biggest economies. But yesterday that didn't hurt the Nikkei. Nikkei's up. So I'll wait and see what the Bank of Japan's going to do today. Nothing out in Australia of note. A couple of things I picked up this morning. Excuse me, showing you the side of my face, which I know is much less attractive than the front. Have a look at that chart. Have a look at 20 seconds on my chart of the day on gregmckenna.com.au. That's got the, you can have it up close and personal look at the Aussie ASX market. Also, have a look at what Albert Edwards has had to say about QE and Mario Draghi. He's basically said that Draghi is full of hubris and it's not going to work. Now, I guess I'd have to agree 100% with that. You know, QE has started to work in the US because the US is a dynamic economy. In many ways, Britain is also a dynamic economy, and certainly Australia is a dynamic economy. Europe, on the other hand, is a moribund economy, and they can do QE until the day I die, and it still won't work. That's my view anyway. So I agree with Albert Edwards, but have a look at my 20-second piece on Business Insider. Also, keep an eye on credit spreads and credit and corporate bonds around the world, particularly in emerging markets. I know our editor at Business Insider, Paul Colgan, is keen on us watching this and keeping an eye on things. I kind of assimilate the fact that emerging market credit is the next, you know, leverage point for a bit of a global market funk at some point, particularly if Chinese growth does continue to slow. It appears that they have downgraded their growth to 6.5% for the next 5 years. That's kind of filtering out through a few places, but it's not really yet certain. So we'll have to wait and see. But that's it for me. I won't be doing much trading today. Got to go down to Newcastle for some meetings. So I'll leave it there. You guys have a great day. Keep an eye on that level in the ASX. Keep your eye on the Aussie. I'm probably less bearish today than I was, you know, this week earlier, as it was slip sliding away once it broke that 71.80 region. You know, it's down the 100 odd points I thought it might get to. It could go another 30 or 40. But I'm not getting uber bearish, and we'll see how it closes the week. Gold's obviously down. Iron ore's up a bit. Copper's down at 232 again. So there's lots of moving parts in this global market action. Keep your eye on the S&P. Its price action wasn't terrible last night, and it's still above its 200-day moving averages. So no point getting bearish unless you see some sort of reversal. As I say, 21.35 is still entirely consistent with what we've been seeing. I'm not buying. I'm looking to fade this rally. So good luck. You can catch me on Twitter at Gregory McKenna. You can always find me at Business Insider, and you can also find me at my own website, gregmckenna.com.au. Have a great day, have a great weekend, and hope you have a profitable day's trading. Bye for now.